Diversification is a well-known strategy designed to reduce risk and enhance returns. Today, more investors are going beyond traditional stocks and bonds, diversifying into alternatives. Alternatives include a broad range of investment options, such as real estate, infrastructure, private equity, and private credit. Combining alternatives with traditional stocks and bonds can help make portfolios more resilient, with the potential to enhance returns, generate income, mitigate risk, and hedge inflation. Let's explore these options together. Real estate is considered a highly established alternative investment. Rather than purchasing or managing properties yourself, you can diversify your portfolio through a variety of private or public real estate vehicles. These investment options span different sectors, such as residential real estate, including apartment complexes and homes, commercial real estate, such as offices and retail space, or industrial real estate, like factories and warehousing. Real estate values tend to fluctuate less in the short term, which has the potential to provide greater stability. Historically, established properties typically produce steady and consistent cash flow, while providing an attractive form of regular income. Properties with occupancy, management, or deferred maintenance issues, on the other hand, potentially can generate significant returns over time after operational improvements. Another class of alternatives is infrastructure. Infrastructure consists of the actual systems that transport goods, people, commodities, and data. Asset owners run and operate these underlying networks, whether it's a toll road, pipeline, or telecom tower, and they make that infrastructure available to customers who often commit to payment by contract, providing the owner with predefined revenue streams. While every network and system is unique, these essential services share specific traits that have the potential to produce better outcomes. Often constructed to last decades, infrastructure is backed by long-term revenues that are contracted or regulated. High barriers to entry make it difficult for new participants to enter the market. There's built-in protection against inflation due to contractual price adjustments, or a market-dominant position that allows for price increases. And the ongoing operating costs of these assets are relatively low. Combined with a growing revenue profile, this can help boost profits over time. As infrastructure is essential to any economy, these investments often perform well throughout various market cycles, including times of market uncertainty. An additional way to diversify your portfolio is to consider investing in private equity. Remarkably, 87% of companies with revenues over $100 million are not traded on a stock exchange. These companies are private and include everything from startups to mature, well-established brands. While public companies issue earnings reports on a quarter-by-quarter basis, private equity does not face that same pressure. Once a viable firm is identified, they can make changes and add efficiencies over time in order to drive growth at scale. Private equity firms exit through an IPO or by selling to another buyer, so this asset class is less liquid than publicly traded stocks. In return, private equity performance has outpaced public equity for the past decade. Now, let's explore private credit. Simply put, private credit refers to the segment of the loan market where non-bank lenders provide businesses with financing solutions without the use of a traditional bank or intermediary. Private credit is a highly selective process. As these loans are not traded publicly, yields are usually higher to compensate for additional risk and less liquidity. To mitigate this risk, diligent lenders will invest the time to fully understand a borrower's business model and capital needs, and to peel back the complexity within that industry. Several factors can make private credit appealing. Floating interest rates and shorter loan terms tend to offer greater protection against inflation and rising rates. Plans for regularly scheduled payments provide for an attractive ongoing income stream. And as a tailored financial solution, lender covenants and collateral are designed to help protect creditors, including repayment priority in the event of default. With the potential for lower volatility and stable income, private credit has become one of the fastest-growing asset classes. We believe that alternatives represent an attractive way to diversify a portfolio. In fact, there are many reasons why investors are increasing their allocation to alternatives. Like stocks and bonds, you'll find that alternatives provide an array of strategies, each with a different risk-return profile. The range of potential benefits include diversification, inflation hedge, risk mitigation, income generation, and return enhancement. Today, investors have more access to alternatives than ever before. Each opportunity is distinct, and you'll want to fully understand the nuances so you can be confident in your decisions. Work with a financial professional with access to world-class alternative investment solutions. One who can help you design a portfolio that meets your needs. Ready to learn more? Visit the Alts Institute today. The role alternatives play in a portfolio varies for every investor. When alternatives are the answer, we help with the questions.